there was something that John Burbank from, I forget what the name of his fund is, but John Burbank was just like uh, this legendary trader that you hear in the back rooms, and he said this thing that it really stuck with me. He said every 5 years, you have to assume that every 5 years everything changes, that some fundamental something that you think is fundamental within the structures of markets is changing dramatically,
Hmm.
and maybe that change doesn't really pick up speed until maybe the next 5 years or the 5 years after that. But you have to assume these things are occurring. And so, like, one of those things is the passive investment, right? Passive
Sure.
investing was like so minimal before, and it just kept quietly increasing as they made different regulations that favored passive investing. And then all of a sudden it tips over and people go, hey, why are there more bullish flows within the market that seem to have um no change to their buying pattern? Like, what's going on? And then now we have this whole thing that's been popularized, where passive investing is outperforming active investing, not because it's choosing any assets based on quality of the asset, but just because it's part of the index, and the funds are being allocated to it. So complete change the dynamics of the market. And so then you can imagine, if that sort of thing keeps happening in 5 years, well, we might see a hockey stick of asset prices, but also stuff like, after the global financial crisis, and they issued Basel one, two, and three for changes in how regulation occurred with banks. Well, all of a sudden, banks were no longer the main source of systemic risk that we're so used to in the pre global financial crisis era. And so, comparing things that happened before the dot com bubble, LTCM, the what was it, the Asian markets that collapsed in the 80s and all that sort of thing. Well, those causes were no longer around. It was a completely different environment. And so I find it very fascinating how the strategies that I want to be following, I almost have to recycle the way that I think about the markets. I'm always like recycling the way I think about the markets every few years, assuming that something that I completely believed was true before might be completely different now, and opens up a trade that's like unlike anything before. For
Yeah.
example, the one I'm in right now for, like, the Bitcoin chart that keeps passing around, of Bitcoin headed to whatever 100,000, a million, or whatever in this curve that everyone knows, might break, and we might have Bitcoin double in a like it could double in 2 years. Like, we don't even know what can happen there. So then I go, okay, I want to participate in that, because the assumption is that what has happened over the last few years should continue. But my assumption is either it'll fall to zero or actually jump up far higher. The thing I could bet on for me is that it won't continue the way that it's being predicted. That's the one thing I think is not going to happen. I don't know. What do you think about that?
Well, there's a few things to unpack there. I think um, the idea that you change your viewpoint on markets every 5 years or so seems really solid to me, because there are pretty large periods of time in which things tend to be true, but then change significantly because market structure changes and market participation changes. Maybe a perfect example of this is an investment thesis that Barclays released back in, I think, 2021, maybe 2022, to their investors, indicating that part of their strategy was to profit from selling premiums to retail options traders, because they had discovered that many of the retail options traders were basically just amplifying implied volatility. And there was this massive gap between IV and HV. And they measured it by looking for, seeing as sort of a mean reverting trade. If implied volatility was well above historical volatility, or even well above historical implied volatility, there was this interesting opportunity to just start selling premiums to retail and profiting from that in sort of a relatively low risk environment. Um, I'm paraphrasing the paper. I'm sure it's more complex than that, but what I'm trying to describe here is that even the institutions are looking for regime changes like this, in which market participation changes in some meaningful way that presents a new type of arbitrage opportunity. And I think that that's the way we should think about markets as well, is that every 5 years or so, maybe every 10 years or so, we have to take what we knew was fundamentally true at some point and realize that the way we're measuring markets today is fundamentally different, and there's a reason for it. And then discovering what that reason is helps us understand how to inform our approach, or at least our viewpoint on markets. We can make the claim now because you and I, in our generation, have enjoyed significant upturns in markets, right? Like, we can make the claim that for the most part, the S&P 500 is just going to go up and to the right. That's just where it's always going. You can bet on American companies. They're always profitable now. They're always doing well. But there have been periods of time where the market's just gone sideways for a long time, and people are like, why invest in stocks? Stocks are worthless. Like, they're not going anywhere. There's not any meaningful returns. I'm going to put all my money in bonds because I'll get a better return over there. So those viewpoints change depending on how we currently measure the market. And I think that is a solid approach to revisit your view of markets every few years or so, and make sure that you have an accurate view on what's actually happening and where money actually is. I think it's fair to say that, like, money managers do this every quarter. They're reevaluating what's profitable. They're looking at the efficient frontier. They're looking at the capital market line. Where can our funds go, and where are we measuring risk and reward, right? Like, where's the best spot to put investor funds right now? And they're constantly hunting where that relationship is.
Do you find that they're hunting? Because sometimes I worry that they're trying to place things based on how to make sure they keep their job, understandably.
Oh, 100%. Yeah.
And so that's where I go, like, well, I want the person whose objective is aligned with me and not orthogonal to it.
Yeah, that's an incentive cost bias, though, right? For them to present an opportunity that feels like it comes with a certain amount of risk, but then there's also some incentives for them to present it that way. So it's tough. It's, again, why I don't want to put my money in somebody else's hands.
Exactly.
I know my own incentive, and my incentive is to take the risk I'm comfortable with, but get the upside I'm hoping for.